Hey guys, hi. Welcome to another episode with me, Shashank Udupa. And in this episode, we're going to tackle a very important question that a lot of people have been asking me. And that question is, how many stocks do we own in our portfolio? Now, this is very crucial to understand because there is no right or wrong answer with how many stocks you need to own in your portfolio. But the important thing is to understand what are the different factors that play into the stocks in your portfolio and how to manage your portfolio very well and in a smart way. So, in the first segment, we're going to look at how diversification plays a role, both from the positive side and from the negative side. And then we will look at how many stocks you should own as an individual. Again, there is no right or wrong answer, but this video is just to give you a number so that you can explore about how you can build your own custom portfolio. Okay, I'll see you guys in the next segment. Now, have you heard this saying, don't keep all your eggs in one basket? Okay, that means diversification is very crucial when it comes to building your portfolio. Now, if you keep all eggs in one basket, which basically means if you put all stocks in just one, component, the risk of that portfolio would be very high. So let's look at what diversification basically means. Now, diversification is basically investing in assets that are not correlated to each other. Not correlated to each other means that one stock or whatever you invest in, if you invest in one thing, it is not correlated to the other thing. So if one goes down, the other goes up, you are balancing your portfolio. Okay, that is what diversification basically means. Now, the idea of diversification is to basically, if something goes down, the other goes up, you balance your portfolio out so you don't gain or lose a lot of money at the same time. So this makes your portfolio quite stable and secure. Now, if you look at an example perspective from historical examples, look at gold and stocks. Okay, they're differently related. They're not obviously related to each other. If the stock market goes up, you usually see that the gold slightly might go down. But the fluctuation of gold is not as much as the fluctuation that you might see in the stock market. So there are two different investing assets that you would invest in with different correlation from each other. Now, this is the basic understanding of how diversification helps you to reduce risk. Now you'll ask me, Shashank, okay, that gold and stock example was fine. But if I'm only investing in stocks, how do I do diversification there? A very important question and a very smart question as well. Now let's assume something. Let's assume you're investing in only one stock. Okay, let's assume you're investing in one stock. Every time you invest in a particular stock, there are three types of risk that you're actually taking. Three types of risk. The first risk is called firm specific risk. Firm specific risk basically means that if anything happens within the firm, if there's a bad management decision or even a good management decision, the risk of it going down if the bad management decision is there, it is equal to only the firm and it is limited to that company's firm. So that is called firm specific risk. Now that you have to do good research to understand whether the company is good or bad, whether the management team of that company is good or bad to offset that risk. The second risk is what we usually see is called an industry or a sector specific risk. Now, industry or sector means, say, for example, the cement sector or real estate sector. When COVID happened, the real estate sector took a big hit. So that is the entire sector that is going into that risk. So that would be another risk that you would incur where an entire sector might go down and you have no option because you've invested in that particular stock. It might go down for you as well. Now, the third risk that you might incur when you invest in stocks is called market risk. Market risk basically means if the entire economy is going down, okay, it doesn't matter whether it's a firm or whether it's a sector specific risk. If the entire market is going down and there is a big issue, everything goes down at the same time. So that is called market specific risk. When you invest with diversification, when you try to put different things in different baskets, especially when you diversify with stocks, you can offset two of these risks, not three, but you can offset two. The first two you can offset. The first one is basically the firm specific risk that can be offset. The second one is the industry specific risk that can be offset. Market specific risk cannot be offset so easily because, if the entire economy is going down, then you're in a big issue as well. So let me give you an example of how you can build your portfolio in this way while managing both firm specific risk and industry specific risk. Now, let's take, for example, you're investing in a particular stock, okay, which is in the pharma sector. Just take an example. You're investing in a particular stock that is in the pharma sector. Now, if I put all my stocks in the pharma sector, if I buy 10 stocks and put all the 10 stocks in the pharma sector, I am exposed to what? Firm specific risk and I am exposed to industry specific risk. So if the pharma sector goes down, my entire portfolio might go down. So that is bad. And I would say, no, let's diversify this, Shashank. So let me put one in maybe a few stocks in the pharma sector. Then maybe let me put a few stocks in the cement sector, or maybe let me put a few stocks in, say, cyclic sectors like steel, where the demand might go up, maybe in some commodity stocks, and let me diversify that way. So for example, Tomorrow, if the pharma sector goes down, but the commodity sector is going up, then my portfolio is still balanced and I don't lose so much money when everything is going down. So that is the basic understanding of how to diversify. Now, even if you diversify between say two different sectors and different kind of firms in your portfolio, the third risk that I mentioned, which is market risk, that is something that you cannot control. It is not in your hands. For example, if there is say rising tensions between two countries, right? When we see rising tensions between two countries, or if there is a war that has started between two countries, you see that the stock market crashes because of the bad news, which might impact the economy. When something like that happens, whether you're in a particular industry or whether you are in a particular stock, it won't matter because everything would go down at the same time. Understood? Now, that was with relation to risk and how to manage risk with diversification. Now, let's talk about how to get returns or how to understand how returns work with diversification. Now, it is true that when you diversify, you reduce risk. But do you know that if you diversify a lot, you might reduce your returns as well? Okay, this is something that is very important to understand. Now, if you listen to the greats, right, Warren Buffett and Charlie Munger, both of them have said that don't diversify too much. The reason being, if I buy too many stocks to diversify a particular portfolio, if I buy too many stocks, then what happens is just to offset some losses, some gains will get offsetted, but I won't make a lot of money in the long run. So it is not good to over diversify your portfolio as well. So if you give an example, right? If I have this brilliant idea and I've done this amazing research on a particular stock and I feel that this stock is the future stock, it is a multi-bagger and I'm going to invest in this stock. But you know that weightage of that stock, because I've over diversified, maybe I have 20 stocks in my portfolio and the weightage of that stock is only 5% or maybe 3% of the entire portfolio, then even if it goes up tomorrow, it hits upper circuit, I won't make a lot of money. Why? Because the percentage of that is so less because I have offset it with 20 or 30 different stocks in my portfolio. So over diversification is very, very, very bad. Okay, so don't do over diversification. Only invest in those stocks that you feel is crucial for growth. And just don't over diversify it as well. Now, if you look at Peter Lynch, he said the same thing. He said a lot of successful hedge fund managers don't over diversify. It over diversifying basically feels like, imagine you're doing this, supermarket contest where you're going, in this supermarket contest where you just have to go with a basket and fill as many food as possible and then take it to the counter. So I've seen a lot of people who try to invest simply in different type of stocks. They'll be like, Acha, all this is done. Let me put maybe 2 more stocks from that sector so that my portfolio is diversified. The goal is not to have this perfect rounded diversification type of portfolio. The goal is to maximize returns over a period of time so that you can beat the benchmark index. Now, you can do that by investing in good stocks with your own knowledge, but not over diversifying it as well. So I know sometimes you might see that, I found these 15 stocks or I found these 20 different stocks that are damn good for me to invest, but it does not necessarily mean you have to invest in all of them to make your balanced portfolio. It is okay to not over diversify it. You have to diversify, but it does not mean that, okay, I just go buy one stock and, I'm not going to diversify, I'm smart. That is not right, because then you have 3 different type of risk you're playing against. Try to diversify as much as possible, but don't over diversify is what I would say. Okay, now comes the main question. How many stocks do you own, right? Now, let me tell you now you're already familiar with the risk and rewards of diversification. You know what the risk work at, you know how the returns work, you know how to maximize returns. Now you will come to the final question saying, okay, now tell me how many stocks do I own? And I'm telling you this, the answer is not definite. The answer is it depends. Now it depends on what? It depends on a lot of factors. For example, let me tell you one thing. Investing is a full-time job. Okay, it is definitely a full-time job because you need to first do research about the business you're investing. You need to do research about the company you're investing. You need to also research about the sector that you're investing. Apart from that, you have to keep track of the stocks that you have invested in. So if you have 20 stocks in your portfolio, you need to keep track of each and every stock in that portfolio when the results are coming out. Did they announce bonus? Did they announce dividends? Is the result good? Is the result bad? Should I change that from my portfolio or should I still keep it? So if you have a lot of stocks in your portfolio, you have to keep track of this. So it is like a full-time job that you have to keep doing research. And apart from that, it's not only about doing research about the particular stock, it is also doing research about the particular industry. So for example, if I am investing a lot of stocks in the pharma sector, but I have no idea what the pharma sector is, then it's very difficult for me to understand because tomorrow there might be some rules or regulations that have changed, which is industry specific risk. Something might change from that angle and I don't understand what is happening. If you don't know a particular sector, if you don't understand pharma, banking, it's fine. Pick up one sector, start learning about that sector. And once you become an expert in that sector, start investing. And it's always about growth in the stock market. So again, it is advisable to stay away from sectors that you have no idea. Now, another important variable comes into the picture is that, okay, how many stocks do you actually have to invest in? Now, there's two ways. If me as an individual have already over diversified before, for example, if I've invested in different asset classes, say I have some money in debt, I have some money in gold. Okay, so I've already diversified some allocation of my money. Then if I'm going to invest in stocks and the investment amount in stocks is very small compared to gold and debt, then I don't have to over diversify. I don't need 10 stocks, 15 stocks in my portfolio. I can actually put lesser stocks in my portfolio because I've already diversified my entire net worth into gold, debt, and now a small portion in stocks. So that is also a very important variable. But if you're putting everything into the stock market, then you have to be a little careful about that. Now the last part, okay, the final instrument or variable to understand how much stocks to keep in your portfolio depends on your investment goals. Okay, I told you this. Every time you enter the stock market, you have to ask yourself this question: why am I here? Okay, it is not about making quick money. Is it about making long-term capital wealth? You have to ask yourself, why am I here? Now, there's two types of things that you can do. One, you're saying, okay, Shashank, I'm just going to preserve my capital for a long period of time. I want to do long-term wealth creation. If you want to do capital preservation and you want to have long-term wealth creation, then it's better to just start investing in a diversified portfolio so that your wealth does not go down, but it's just going up. Not that fast, but it's still going up. The second type of people are there who have these investment goals, who are young, who can take more risk and say, you know what, I don't want to over diversify right now. I'm quite young. I don't have a lot of responsibilities. I can actually invest and try to grow my portfolio fast at this point before I have to diversify it later in the future. So those type of people can have less stocks in their portfolio, so they don't have to over diversify and can try to maximize returns more. But again, don't forget the risk also there is quite high. Okay, so now you understood the 4 or 5 different variables that go into how to understand whether your stock is good or bad and how to understand whether a sector is good or bad. You need to do your research. So there are so many variables that come into this, and that is why it is very important to understand how many stocks do you own in your portfolio is not a single variable. Okay, there is so many factors that depend on it, and you need to find a perfect balance between how much risk can I take and how much returns can I maximize in this perspective. And look at, review this entire video once more if you didn't understand a lot of things. You're offsetting risk, you're maximizing gains, and then you have to choose your investment goal and then figure out whether me investing in this is good or me investing in this is over diversification, or should I just maximize returns. So please understand from that perspective. Again, guys, if you like this video, lot of knowledge, lot of wealth of knowledge. Most of you all might know already what diversification is, but there are so many different angles to diversification. There are good and bad things. So I want to understand from you guys, if you like this video, please like, share, subscribe, and comment below. And also put in how many stocks do you think is the perfect portfolio for you guys. Okay, I'll see you guys in the next episode. Hey guys, just a disclaimer. Everything shown in this video, all the stocks, all the funds, anything shown in this video is only for educational purposes. We do not recommend any buy or sell on any of these stocks or funds. Okay.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.